We got yet more earnings beats from the giant U.S. lenders. Bank of America and Morgan Stanley both topping expectations. Let's get more now from a guy who spends a lot of time drilling into the U.S. bank numbers, Mike Clare, Senior VP and Senior Portfolio Manager at Brompton Funds. Great to see you. Thanks very much for joining us.
Great to see you. Thanks for having me.
Start off with Bank of America. What was interesting for you there, Mike?
So I think Bank of America had a really strong quarter. We think that they're among the banks that are best positioned for the current environment, and they're really all their business lines are firing on all cylinders. So if you look at top earnings per share, it was about a 12% beat versus expectations, growing at about 30% year over year, and it's really all of the business lines that are contributing to this. So you've got of course, the core business of banking, driving a net interest income beat, growing at 9% year over year and 4% versus the last quarter. That's a substantial part of their business and something we're pretty bullish on looking forward. Also, you look at the capital markets business on the trading side. Of course, trading businesses across the street and across all of the banks have done really well over the last several quarters. So expectations are elevated, but again, Bank of America delivered a solid beat on the trading side, particularly on equity trading, which is a consistent theme we've seen across the street. And then lastly, on the investment banking business, this is an area we've been beating the drum on over the last several quarters, talking about how it's a good environment for banking and deals are going to come. Well, we've started to see that really start to accelerate in the third quarter here. Bank of America's investment banking business beat by 25%. It's growing at about 40% year over year, and we've seen really strong results across all of the business lines within investment banking, including advisory, M&A, equity capital markets, debt capital markets, and so it's an area that's really starting to turn up here and really starting to do well, across all of the banks here.
And Mike, are they already seeing cost reductions because of AI?
So we're not really starting to see cost reductions yet. I think what we are starting to see is we've seen, for Bank of America and a number of the other banks, we've started to see positive operating leverage come back, which is just a fancy way of saying that revenue growth is starting to outpace expense growth. And so I think what you're seeing is you're going to see the banks start to slowly adopt AI, and this will slowly have an impact on their expense line. But I don't think you're going to see expenses decline. I think what you're going to see is a number of banks try to keep headcount flat, try and use AI and technology in various ways to help keep that expense line flat or growing very slowly as they continue to grow the top line, and that'll drive positive operating leverage and greater efficiency in the business, really.
I can't believe the scale of this bank. They have almost 70 million consumer and small business clients. I mean, that's a chunk of the entire U.S. population.
Yeah, it's roughly 70 million clients, 3,700 branches. They've actually, despite that, they've been able to grow new checking accounts 27 quarters in a row. And we think they've done a really good job investing in the business. We've started to see them grow market share to some extent, and we expect that to continue into the future, particularly as capital frees up. Of course, these banks have spent the last 15 years building their capital for these ever increasing capital requirements from regulators, and now that that's starting to change, we expect not just to see share buybacks, but we expect to see banks like Bank of America really invest in the business, invest in loan growth to help support the economy, which is, the U.S. economy is really firing on all cylinders here as well. So it's a great time to have excess capital to be able to help, grow the business and support loan growth.
It looks like in terms of financial stocks, maybe we could put up a 5-year chart for BAC. Bank of America has been really a middle-of-the-pack, respectable performer, 133% total return over 5 years, including dividends, almost exactly in line with the S&P Financial Index.
Right. It's been a bit of a laggard. It's one of the banks that was had a more difficult time through the financial crisis, so it's been taken a little bit longer to right the ship there. But I think that they've really positioned the bank now here to benefit from the current environment. And we expect them to continue to perform well going forward.
Yeah, I mean, JP Morgan, a return over that 5 years of about 240%. So that's been the darling.
Right.
Then Morgan Stanley, this stock has been pretty good as well. 5-year total return north of 250%. What jumped out for you with their results?
So really what jumped out for me here is, again, we've been beating the drum on this capital market cycle that's coming. And really, they delivered an excellent quarter here. It's been a number of quarters in a row that they've delivered strong results. Expectations have risen with that, and somehow they were able to manage a pretty significant beat again. So earnings per share about 30% ahead of consensus and growing close to 50% year over year. The equity trading business in particular continues to do very well. So we saw a strong beat in trading. And then again, similar to Bank of America, the investment banking results ahead by about 25% versus expectations and growing north of 40% year over year. So again, this is an area that the management team has highlighted as something they're optimistic on. I think it's a good environment for the banking business. We see, obviously equity markets have been strong. We see a number of sponsors with assets that they want to bring to market, whether it's through new IPOs. We've seen lots of new IPO issuance, pretty significant uptick in the third quarter, and it's really starting to show up in Morgan Stanley's results.
And just remind us, Mike, before we let you go, I'm always curious, which of the U.S. banks would be the most internationally exposed? I don't know if you have that at your fingertips.
Yeah, well, don't have the exact bank right at my fingertips. I think generally the banking business, if you look at the core retail and consumer banking, that tends to be a domestic business. So it's typically the banks through their investment banking platforms and capital markets that have the most global exposure. So that would be something like a Morgan Stanley or a Goldman Sachs, as they're, of course, overexposed to capital markets versus something like a JP Morgan or Bank of America.
Thank you very much, Mike. Great hearing from you.
Thank you.
Mike Clare, Senior VP and Senior Portfolio Manager at Brompton Funds.